The global macroeconomy right now is facing a completely different set of structural dynamics than anything we witnessed during the historic dotcom boom. Back during that tech run-up, the excitement was built almost entirely on forward-looking expectations, hopes, internet web pages, and early online activity. This time around, the economic story is anchored in massive physical infrastructure investment moving heavily across the entire geography of the country. We are looking at the widespread building of physical data centers, massive localized employment shifts, soaring power company demands, and unprecedented water usage. Because of these deep tangible ties to the broader foundational economy, if we get a systemic market correction, there is collectively a lot more accounting to do. In other words, a widespread market pullback in this specific economic environment will be significantly more painful and far more sector-wide. It will not just be an isolated technology company correction like the one the world experienced in the early 2000s after the internet bubble burst. It will be a correction cutting deeply across multiple foundational sectors, creating a macroeconomic hangover that will take a little longer to get through. To truly understand how we arrived at this specific juncture, we have to look closely at the resilience of the broad indexes over the first half of 2026. Despite ongoing geopolitical shocks and a slow-boil naval conflict that has pushed domestic retail gas prices up 30%, the markets remain remarkably intact. Many everyday investors are looking at these backward-looking indicators and assuming the upward trajectory of the major indices is completely durable. But if you look under the hood of the Standard & Poor 500, you quickly notice an extreme concentration of both market cap and collective corporate earnings. We are currently operating in an incredibly top-heavy financial market where the performance of the entire index hangs on a tiny handful of massive entities. When a few choice technology companies account for a massive chunk of aggregate corporate earnings, systemic risk across the market increases exponentially. All you need is for a couple of those core corporate drivers to experience a serious structural downturn and collective market earnings will plummet overnight. Right now, the massive capital spending commitments from tech giants are creating a fascinating dynamic where artificial intelligence functions mostly as an expense. For the vast majority of the Magnificent Seven companies, these massive capital expenditures are actually putting downward pressure on near-term profit margins. The top-line revenues are growing rapidly, but the massive cash burn required to build the underlying physical architecture is compressing bottom-line profitability. We are seeing immense spending commitments that make up over 40% of the total revenue backlogs for several major cloud computing providers. This creates a fascinating recycling effect, where venture capital funding flows into specialized systems and immediately cycles back into hardware infrastructure. If these massive infrastructure investments fail to deliver high steady-state profit margins down the road, the eventual corporate write-offs will be massive. As a disciplined long-term investor, you cannot afford to get caught up in the short-term momentum or the autopilot spending trends of corporate boards. When the price of risk in the market shifts, assumptions about perpetual growth and long-term terminal value have to be addressed much more directly. The corporate life cycle for software and information technology companies is shrinking because the risk of rapid obsolescence is higher than ever before. This structural shift effectively reduces the long-term valuation multiples that these traditional high flyers can safely sustain over time. Beyond the technology space, macro indicators show that our national debt has officially surpassed 100% of gross domestic product. While high sovereign debt is relatively sustainable if you have a robust expansionary economy to back it up, it becomes highly dangerous during periods of shrinkage. If an infrastructure breakdown or an external geopolitical shock creates a sharp contraction in gross domestic product, the debt load becomes a severe amplifier. We are also witnessing an unprecedented acceleration in the valuations of the global semiconductor and hardware manufacturing sectors over the past few months. A decade ago, chip manufacturers made up a tiny 3% of the total index, but today they have expanded to roughly 17% of the market. This rapid run-up has been driven by an intense, insatiable global demand for processing power and localized memory storage solutions. However, much of that initial momentum has already run its course, and certain components of the chip sector are clearly running on short-term helium. When sectors triple or 6 times in value over a very short horizon, the market eventually demands a period of consolidation and intense margin scrutiny. Nationalistic policies around supply chains are keeping domestic producers elevated, but business economics vary wildly when you look globally. For instance, international competitors often operate on completely different margin structures due to alternative domestic corporate buyers. As an investor focused on wealth building and personal financial discipline, Navigating this top-heavy landscape requires sticking strictly to your core strategy. Trying to perfectly time a sector rotation or guessing the exact trigger of a market correction is a historically losing game. The most reliable way to weather a long macroeconomic hangover is through consistent non-emotional asset accumulation. By utilizing a steady strategy like biweekly dollar cost averaging into low-cost index funds, you naturally smooth out short-term market volatility. When you systematically buy broad index funds like VTI or VOU, you ensure you are not overly exposed to the sudden collapse of a concentrated stock. You want to own the entire economy over a 30-year horizon rather than betting your financial future on temporary hype or cyclical peaks. Building real wealth is about endurance, maintaining a high savings rate, and understanding that market corrections are a natural part of the cycle. When the music slows down and corporations are forced to justify their massive capital expenditures, the disciplined investor stays calm. Ensure your personal balance sheet is completely insulated, keep your investment horizon long, and do not let market noise disrupt your discipline. Let us examine the exact inflation data that hit the wire this week because the numbers are shifting the entire interest rate landscape. The Consumer Price Index for April came in much hotter than the consensus expectations, showing a headline annual increase of 3.8%. Even more concerning was the monthly change, which accelerated by 0.6%, showing that inflation is not cooling down at all. If you annualize that single-month pace of growth, you are looking at an aggregate inflation rate well above 7% per year. The common narrative on Wall Street is that this entire spike is driven by the temporary disruption in global energy corridors and rising oil costs. So if you strip out food and energy to look at the core consumer price index, the annual number is still sitting at 2.8%. Remember that the official target remains anchored at 2%. So a core reading near 3% proves that inflation has become deeply structural. The Producer Price Index, which measures the raw material costs for businesses, jumped by a staggering 1.4% in a single month. When producer prices are rising at an annual clip of 6%, it is only a question of time before those costs are passed to consumers. Even when you exclude food and energy from the producer side, the monthly increase was a full 1% compared to the forecasted 0.4%. This massive data miss confirms that sticky accelerating inflation is moving far beyond simple energy costs and into the broader service economy. These numbers have effectively wiped out any remaining market expectations for a federal interest rate cut occurring during the remainder of 2026. In fact, the probability of an actual interest rate hike before the end of the calendar year has officially climbed past 50%. The central bank has kept its benchmark interest rate frozen between 3.5% and 3.75% for multiple consecutive meetings. But the internal division is growing with the highest number of dissenting votes inside the committee since the early 1990s. With 10-year government bond yields climbing to 4.6% and headline inflation at 3.8%, the real yield is barely positive. For conservative bondholders who are looking for safe returns, a real yield of 0.8% offers virtually no protection for purchasing power. When you factor in taxes, holding long-term government debt right now means you are effectively locked into guaranteed negative real returns. Historically, periods of negative real interest rates have provided massive fundamental support for tangible commodities like gold and silver. Yet we saw a volatile trading week where gold fell 4% and silver dropped a massive 13% in a single day. This short-term weakness is a direct reaction to surging bond yields, which increase the immediate opportunity cost of holding non-yielding assets. When investors can lock in higher nominal yields on safe government debt, they temporarily rotate funds out of precious metals and into cash instruments. Additionally, the global strength of the dollar has put downward pressure on commodity prices, making them more expensive for international buyers. Many market participants who experienced massive gains during the early part of the year are being forced to liquidate their most profitable positions. When hedge funds and institutional desks face margin pressure or need to raise capital, they naturally sell down liquid assets like gold first. However, the long-term fundamental bull case for tangible assets has not disappeared, because central banks cannot easily control this structural inflation. The global debt burden is so massive that policymakers simply cannot afford to implement a massive monetary shock without collapsing the banking system. If interest rates are forced significantly higher, the cost of servicing sovereign debt will overwhelm national budgets across the developed world. Look at what is happening in the United Kingdom, where 10-year government bond yields are rapidly approaching 5.1%. This represents the highest borrowing cost the British government has faced in nearly 20 years, driven by deep political and fiscal uncertainty. The sudden resignation of key health officials to launch leadership challenges against the Prime Minister has added massive fuel to the bond market fire. When political instability combines with structural inflation, international capital naturally demands a much higher risk premium to hold sovereign debt. The Bank of England is now widely expected to implement multiple interest rate hikes this year to prevent a total sterling sell-off. The situation is even more historic in Japan, where the 30-year government bond yield broke through 4% for the first time in modern history. Since Japan did not even issue a 30-year instrument prior to 1999, this marks the absolute lowest bond prices ever recorded there. The 20-year Japanese yield has climbed to its highest point since 1996, and the 10-year yield is at a 10-year high. This matters immensely because domestic producer prices in Japan are currently accelerating at an annualized rate of 4.9%. For decades, the global financial system relied on the Japanese carry trade, where investors borrowed ultra-cheap yen to buy higher-yielding assets globally. The absolute end of the ultra-low interest rate era in Japan means that global liquidity is tightening and capital is flowing back home. Japan carries one of the highest debt-to-gross domestic product ratios in the world, making higher yields incredibly difficult to service. If the Japanese government is forced to spend a massive portion of its tax revenue simply paying interest, the broader economy will face severe stagnation. Despite this sea of negative global macro news, the major United States stock market indices ended the week completely flat. The Standard & Poor's 500 and the Nasdaq are hovering right next to their absolute all-time highs, defying basic macroeconomic gravity. This divergence is happening because the entire domestic market index is being carried by an incredibly small group of mega-cap tech stocks. If you remove the top semiconductor designers and their closest infrastructure partners, the broader market picture looks completely stagnant. The United States equity market has dramatically outperformed European and Asian indices because of its unique structural positioning. First, the United States functions as a net exporter of energy, meaning it actually benefits from higher global oil prices while Europe suffers. Second, the United States is the primary recipient of the global capital flood, pouring into artificial intelligence infrastructure and data centers. In contrast, the European Central Bank is facing severe stagflationary pressures and is expected to raise interest rates 3 times this year. This creates a massive economic divergence where old economies are suffering from high inflation while the new digital economy experiences a massive boom. The market is placing a massive bet that the exponential growth of the digital infrastructure sector will completely offset the drag of the old economy. This is a highly dangerous assumption because the profit margins of these massive digital projects are starting to face real structural pressure. It currently costs artificial intelligence companies significantly more money to operate their data models than they are collecting from actual consumers. We are currently living through an institutional moment that looks very similar to the early days of the ride-sharing applications. Companies are subsidizing the massive cost of computing power to build market share and get consumers completely addicted to the technology. The critical difference is that early ride-sharing platforms did not face immediate widespread institutional competition from every single tech company. Today, every major technology firm is launching competing language models, which drives down consumer pricing power and compresses industry margins. When competition surges in a market where the primary operators are already running at a loss, long-term valuations must be re-examined. The current market expectation is that these tech giants will easily raise prices on consumers down the road to achieve profitability. But with so many alternative digital tools available, raising subscription prices without losing massive user bases will be an uphill battle. If the underlying profit margins shrink, institutional investors will quickly reprice these stocks and slash their forward valuation multiples. This is why chasing individual high-flying stocks at cyclical peaks carries massive structural risk for everyday wealth building. If you want to protect your long-term capital, you must rely on strict personal finance discipline rather than speculative momentum. Maintaining a high savings rate and consistently allocating capital into diversified broad market index funds remains the ultimate strategy. When you practice bi-weekly dollar cost averaging, you completely eliminate the emotional stress of trying to time the absolute market bottom. You are buying fewer shares when prices are elevated and automatically accumulation more shares when the market goes on a massive sale. This disciplined approach ensures that your wealth accumulation journey is driven by mathematical consistency rather than emotional reactions to news headlines. The macro hangover from this physical infrastructure boom will likely take a significant amount of time to fully process through the economy. When the bill for these massive data centers and utility upgrades comes due, corporations will be forced to write down underperforming assets. During that consolidation phase, having an insulated personal balance sheet and zero high-interest consumer debt will be your greatest asset. Do not let the short-term noise of the market distract you from the reality that compounding takes decades to build true financial freedom. Focus entirely on your personal savings rate, maintain your consistent investment schedule, and keep your asset allocation completely diversified. The structural shifts we are seeing in 2026 prove that market dynamics can change far quicker than the mainstream narrative suggests. Stay grounded in your long-term strategy, ignore the daily volatility of concentrated sectors, and keep pushing forward with discipline. Thank you so much for sitting down with me today for this deep dive into the changing global macroeconomic landscape. If you found these insights valuable and want to keep building your financial literacy, make sure to hit that subscribe button right now. Keep your investment strategy completely disciplined, stay focused on your long-term goals, and I will see you all in the next video.